Let's start with our first chapter, Introduction to Technical Analysis. Technical analysis can be used for stocks, forex, commodities, and index futures. Once you learn technical analysis, you can apply it on any script or any trading instrument traded on any exchange in the world. Alright? It can be applied to any trading instrument traded on any exchange in the world. Now, why there is a need for technical analysis? We'll have a small argument between technical analysis and fundamental analysis. In today's dynamic world, reaction of price depend on a lot of fundamental factors. Fundamental factors differ for different scripts. We'll take an example of cotton and a banking stock. Fundamental factors for cotton are climate change, governmental regulations and policies, drought, or any kind of natural disaster. So fundamental factors that will determine price of cotton are climate change, regulations, or some natural disasters. Whereas these fundamental factors won't affect a banking stock. Fundamental factors that will affect price change of a banking stocks are completely different. So what affects price change of a banking stock? Maybe quarterly earnings, its business model, RBI policies, or global financial moves, any kind of important global development. Hence, fundamental factors for each stocks are different. Any two different trading instrument won't have same fundamental factors. It is not possible to keep an eye on every change in fundamental factors. Sometimes the news is shared with general public long after the impact is done on market. Even if we did come across an important piece of news or an important development in fundamentals of a given stock, it's hard to judge the kind of reaction the market will give to that news, to that fundamental development. As a result, fundamental factors, even if we are aware of an important development, it's very hard to make a subjective decision or a subjective judgment. Hence, it becomes necessary to have a reliable medium through which any person can make decisions consistently. You need to have a reliable medium through which you can make consistent decisions. Hence comes technical analysis. Technical analysis is an art of speculating a price behavior through its past actions. Technical analysis does not consider fundamental factors. It deals with price actions and volume traded on markets. Let's go ahead and take a look at some of the qualities of a technical analyst. One of the most basic quality of a technical analyst is he depends on technical analysis and he may not depend on fundamentals for his decision making. A technical analyst mostly or basically depends on price and volume data and derivatives of price and volume, for example indicators, for his decision making. He may not depend on fundamentals. Even if he uses fundamentals, the scope of fundamentals will be limited or very basic. A technical analyst depends on price patterns to identify it and exploit it. He depends on reliable price patterns that keep on repeating in the market. He looks for repetitive price patterns in stocks, and once he is fully satisfied about the reliability of price patterns, then he looks to trade it. He looks for repetitive price patterns, patterns that repeat themselves in each and every stock in any market conditions. He looks for such reliable patterns, and then once he is satisfied, he looks to trade them. A technical analyst may or may not have predefined price targets, but he always have a predefined stop loss. A technical analyst may not have a target how high a stock might go a high or low, a stock might fall, but he always have a stop loss. What if the pattern doesn't turns out the way he is thinking? What if the pattern gets void? Hence, in such situations, he keeps a stop loss. He uses a stop loss just in case the pattern gets void. An important note, work with stop loss. Remember, this is one of the most basic quality of a technical analyst. Use stop losses, work with stop loss. As you will be working with probabilities and not certainties, you need to have a stop loss. Now, a stop loss or a price stop loss, your trading capital stop loss can be either percentage of your trading capital or a part of your trading capital. If you're using a percentage stop loss, it can be 1% or 2% of your trading capital. For example, you're not willing to risk more than 1% of your trading capital on any given trade. Let's take an example. If you have 1 lakh rupees, you may not be willing to risk more than 1/10 of your trading capital on a given trade. So 1/10 part of 1 lakh comes to 10,000. You may not be willing to risk more than 10,000 on any particular trade. So that becomes a part of your trading capital. You can work with anything, either percentage, you can risk a percentage of your trading capital or a part of your trading capital. But what is more important is you must always work with a stop loss. Let's have a small note on market tips. Market tips are floating all around you. You will find them through your friends, you'll find them on the internet, you'll find them with your banker, everyone, everywhere. They will have a, one or the other very important market tips for you. Now, never trade on market tips, no matter how reliable the source. Even if the person who is handing over the tip is your best friend, still do not trade on market tips. You will always find good reasons backing up tips, but the validity of such reasons is still questionable. A technical analyst depends on his own reasons and judgment to select a trade. Alright? A technical analyst depends on himself to select a trade. He may not depend on market tips. He conducts the trade on his own accord rather than depending on some market tips. Hence, remember, the reliability of market tips is highly questionable, hence never trade on market tips. Next important quality of a technical analyst is backtesting. Backtesting is one of the most important quality of a technical analyst. If you as an analyst have found a setup that you believe can be traded on markets, then you must backtest that idea thoroughly before taking it live into markets. If you have an idea, if you have seen a pattern into charts, if you have seen a setup or a pattern that is repeating itself on various different charts, and if you think that they can be exploited for profits, you need to go back into the history of that traded instrument or of any traded instrument. You need to go back into its history and see if that idea has worked there too. You need to test your idea on various instruments in different market conditions. Hence, you need to go back into the history of those traded instruments and test your idea. See if your idea has worked in the past too. Use charts to see past traded history of a script and backtest your idea thoroughly. This will help you see the shortcomings of that idea and how it performs in various market conditions. It will help you get a feeling about your own ideas, whether they have worked well under different market conditions, how they have performed in stagnated market conditions, and how they have performed in volatile market conditions. You will have a feel about your own ideas. Hence, it is very much important that you thoroughly backtest your idea on a wide range of data covering different aspects of market. Backtesting is your third eye as a technical analyst. Hence, remember to backtest your idea thoroughly. Spend hours and hours on backtesting. This will help you get a feel about your own idea.